This is Professor Reynolds, and this is going to be the helpful hints for completing the problems for Module 2. This week you'll have Chapter 3 to read, which is Consolidated Financial Statements at the date of acquisition. And that's what the problems will be focused on this week, is how to create the journal entries and how to create the um, consolidated balance sheet after or at the date of acquisition. In chapter 4, that's going to be consolidated financial statements after the date of acquisition. And that we'll be talking about the three different methods: the cost method, which is normally used for companies that have less than 20% ownership. And there's the equity method, which is used for companies that have 20 to 50% but don't have control. And then there's the consolidated method, which is the method that has to be used when a company owns more than 50% of the stock. And then there's chapter 13, which is reporting for segments and for interim financial reports. And there'll be some problems at the end of chapter 13. And you'll need to write a paper on that, and that is going to be worth 50 points. So between this and the paper, that'll be 100 points. So 10% of your grade is due this week. So let's go ahead and talk about the consolidated balance sheet, consolidated financial statements at the date of acquisition. So your first problem is going to be something similar to this. H company purchased 80% of the outstanding common stock of M company on January 2nd for $400,000. The balance sheet for company H and company M immediately after the stock acquisition are as follows. All right, so what we're trying to do with consolidated financial statements is, one, is we're going to combine the amounts. So we're going to combine all the current assets. We're going to combine the plant. We're going to combine land, liabilities, etc. But what we're going to take out is, since these are both basically going to become one company from a consolidated standpoint, there really is no investment in company H. This investment is going to be offset by these equity accounts for company M. You don't have separate equity accounts for company M because they are part of your company on a consolidated basis. The other thing is that we have to eliminate intercompany type transactions. It says here that M company owed H company $15,000 on open account on the date of acquisition. So M company has an accounts payable. I think it's accounts payable. Let's see. Yes, current liability accounts payable of $15,000, and H company has a subsequent current asset of $15,000. So we need to get rid of those, and it really won't have any impact on the balance sheet other than it will reduce current assets by $15,000 and it will reduce current liabilities by $15,000. So the first thing we need to do is to determine what the uh, cost over book value is. Now, prepare a consolidated balance sheet for H&M companies on the date of acquisition. Any difference between the value implied by the purchase price of the investment and the book value of net assets acquired relates to subsidiary land. So we're going to mark up the land by the difference in the book value over the assets. So we need to determine that first. Now, the purchase price was $400,000, and we purchased 80% of the company. So you can see here that B22 divided by B23, all right, the purchase price divided by the purchase percentage will give us an implied value of $500,000. The net book value of the assets you can see here, well, property, plant, equipment is 230, or book value would be, let's see, really, okay, the common stock account. So that's going to be $372,000. So the difference between the implied value and these equity accounts is going to be $128,000. So we're going to add that to the land value. And we've got the current assets here. And so we're going to add the current assets for both companies, but we're going to subtract out this $15,000 here. So we're going to add the current assets for H to the current assets for M, but subtract out the $15,000 that M owes H. And so we get a value of $237,000. Plant and equipment, we're going to add both of these, 565 plus 232. And then land, we're going to add both of these plus the difference here, which is attributable to the land. And then we do the same thing. Current liabilities, of course, would be the current liabilities less the $15,000 that we owe. Long-term notes payable would be the same, but common stock is only going to be really the common stock for H company. We have these accounts were eliminated really when we have the investment in M, but that's eliminated as well. And the difference, of course, would be due to the land value and the other contributed and the non-controlling interest, okay? So the non-controlling interest, of course, would be the implied purchase price less the actual purchase price. So that should get you through that problem. And then we have a little more complicated problem, 3.8 and 3.7 is probably going to be similar, but let's go over 3.8. So again, the objective here is that we need to negate any accounts, any intercompany. As you can see here, there are going to be three companies involved, and Coronado is going to purchase a percentage of Jennifer and a percentage of David. You can see all the accounts here, and there's additional information. So 1 week before the acquisition, Coronado Company had advanced $12,000 to Jennifer Company and $4,400 to David Company. So Jennifer Company recorded an increase to accounts payable for its advance, but David Company has not recorded the transaction. So we need to record that transaction. Hopefully, they'll put it on their books, but for the consolidation purposes, what we're going to have to do is we're going to have to add that. So we've got an entry here for cash, and you can see that we haven't accounted for the cash that went to David. So we have to add that to the cash balances because the cash is already left Coronado, but we haven't added to David. So that's the first entry, and that's not really a consolidated entry other than that's an entry that should have been done. So that's the first entry here, okay? And then we've got these intercompany accounts that we have to eliminate. So on the date of acquisition, we had Coronado owed Jennifer, and David owed Coronado, and Jennifer for purchases. The goods purchased had all been sold to outside parties prior to acquisition. Now later on, we're going to find out that when they aren't sold, we have to take back that profit, and we can only really account for it when it's all sold to outside parties. Coronado Company exchanged 13,300 shares at a fair value of $12 for the outstanding stock, for 95% of the outstanding stock of Jennifer. They paid $4,500 in fees. Coronado paid $51,000 cash for an 85% interest in David Company. $3,500 Jennifer Company's notes payable and $10,200 of David Company's notes payable were payable to Coronado Company. All right, so Coronado Company has on their books numbers that we're going to have to eliminate, and then we'll have to eliminate the subsequent notes payable on when we do the consolidation. Assume that for Jennifer, any difference between book value and implied value by the purchase relates to subsidiary land. Okay, so there will be no goodwill, at least for that part of it. However, for David, assume that any excess of book value over the value implied by the purchase is due to overvalued buildings. The thing we need to do is to determine what the implied value is and what the non-controlling interest amount is. So for Jennifer, purchase price was $159,600. And where did we get that? C69. So C69 would be 13,300 shares times the market value of $12. Okay, so you can see here, it's note 3. And so that amount was 159,000. We purchased 95% of that, so the implied value is 168,000. And the difference would be the non-controlling interest of $8,400. Now we have David, and let's see, David, we paid $51,000 cash for the 85% interest in David Company. So we paid $51,000 cash. Percentage ownership is 85%, so that has an implied value of $60,000. And so that means that the non-controlling interest is $9,000. And so the difference between the implied and the book value is $8,000, okay, which is the implied total value less, again, these equity accounts. So purchase price for implied value is 60,000 for David, okay. The book value is actually higher, all right? So you've got these accounts here, which are 76,700, okay? And so here you've got the difference of 16,700, but the opposite sign, okay? Normally we would see a higher level. So what we're going to end up doing is we're going to end up decreasing the value of the buildings. Now, intercompany for the Coronado, we've got AR that is outstanding between Jennifer. We've got $4,400 for Coronado. That amount hasn't been recorded. And then we've got Jennifer and Coronado, 12,400. All right, so one, give the book entries to record the 2 acquisitions in the account of Coronado Company. All right, so we gave stock in the amount of 13,300 at the market value of $12 a share. So we have an investment of 159,600 in Jennifer Company, okay, and that is the common stock is the number of shares times the par value. Now, where's the par value? We can see up here that the par value of common stock is $10 per share. So that means, though, that the difference is going to be the 12 minus the 10 and minus the amount that we paid for the stock issue. So that amount will go to other contributed capital, and then we had cash of $4,500. And then for David, it's just simply investment in David and a credit to cash. All right, so B is prepare a consolidated balance sheet work paper after acquisition. So now we have to go through and let's look at the cash account. And the only difference is that we need to increase cash by $4,400. That's the advance to David that wasn't recorded on David's books. All right, then we need to look at accounts receivable. And we have accounts receivable of $22,000, okay? And that's made up of this 12,400 and the 4,100 and That should be the 22,000. Maybe I'm awful. Yeah, 22,000. Okay. So on the books, between the three companies, there was a total of 22,000 that needs to be eliminated because you can't owe to yourself. You can't have an obligation to yourself. And then we have notes receivable. Same thing. So we see the notes receivable are going to be um, or 13,700. Okay. And so we're going to eliminate that. And then we're also going to eventually eliminate the notes payable because again, this is all one company. So you no longer have that. And you'll see um, the accounts payable we'll look at in a minute. Okay. All right. So there is no investment in either of these companies because you can't invest in yourself. And then we have the difference between the applied and the book value, which represents, of course, these two amounts. 24,700. All right. And so that again is C50 plus B44. Advances to Jennifer Company, we need to eliminate that. All right. So we need to eliminate this 12,000 here. And then we need to eliminate the 4,400 for advances to David Company. Again, you can't have an advance to yourself. All right. So those will be eliminated. And then land, we are going to increase the value of land, and that is going to be due again to this. See which note that is. Difference between the book value and the value applied for purchase relates to the subsidiary land. So we're going to increase the difference here of $8,000 for the implied book value. Okay. So that's going to increase the land. But for the other company, we actually had overvalued assets. So we're going to decrease that. So the land is going to go from a combined 324,000 and add the difference in the book value. But for the buildings, we're going to decrease that. All right. And then equipment, there's no changes. We just add those together. So that is the asset side. So now we'll look at the accounts payable. So the accounts payable is going to be, so we need to eliminate any intercompany accounts payable. And so these are all the accounts payable that are on the different books. So we've got 12,000 for Coronado. We've got 4,400 for David, which of course we added back. We've got 12,400 on purchases on account. We've got 4,100. We've got 35. So all of these are currently listed as accounts payable on one, two, or three of the companies, and we have to eliminate that. And of course, here is the additional amount that wasn't recorded. That's the $4,400. All right, so we've got a net amount of about 30,300. Income taxes payable, nothing about that. The notes payable, again, we're going to eliminate the notes payable because you don't have a notes payable between yourselves. So we're going to eliminate this line here. And the common stock, because we don't have investment, we don't have common stock. The only common stock really is going to be for the parent company. So we're going to eliminate the common stock for both of these companies. We're going to eliminate the other contributed capital for both of these companies, and we're going to eliminate the retained earnings for both of these companies. And that's fairly straightforward. We just pull the amounts down here, okay? and Jennifer Company had a positive balance, but David Company had a negative, so we have to offset that. So we basically zero out these amounts. And then we add back the controlling interest of 17,400, and that is a credit. And then we have the NCI. So that actually is an error in the program. Let's see, should be minus this. All right, so we are going to end up with 17,400. So you see the liabilities and equity are 980 and the total assets are 980. So really these are going to be just debit, of course, on the asset side would be an addition. A credit would be a subtraction. And the opposite is true here. We're going to add these three together. We're going to subtract out because, again, these are credit balances. So a debit will be a subtraction from the number. And then we add back the NCI. So hopefully this will help you prepare a consolidated balance sheet. And so really what we're just basically doing is we are adding all of these together and we are going to list them by liquidity. So we're going to separate them into current assets and into long-term assets. But at this point, all you're doing really is pulling the balances from the consolidated total. I hope this helps. This should give you some good idea on how to complete these problems. And if you know 3.7 or 3.8, then 3.7 should be fairly simple. And then 3.2 will be 3.3 and 3.4.